Adjusting entries. Why do we need adjusting entries? At the end of each period, we need to make sure that the revenue of a period is matched with expenses for the same period and related to the revenue. That is what we call the matching principle. So revenues that are only related to period 1 must be matched with the expenses related to the same period, while revenues related to period 2 must be matched with expenses related to period 2. Sometimes, not all revenues and expenses are recorded, so they need to be recognized at the end of the period to include them to follow the matching principle. While in other cases, revenues and expenses are recorded in excess and need to be reduced, since they are not yet recognized. Let's illustrate. So if revenue was received but they belong to a different period, then it cannot be recognized in the current period. We need to defer the unrecognized part to the following periods when they can be recognized. This is what adjusting entries do. Sometimes, not all revenues may have been realized during a given period, but should be recognized and recorded for the same period. The purpose of the adjusting entries here is to include such revenues in the given period. On the other hand, expenses might be recorded in a period, then at the end of the period it is noticed that part of these expenses are not consumed, hence should not be recognized for that period. So it should be removed from the expenses and deferred to the following period when they are consumed. This is done by adjusting entries as well. In other instances, there are some expenses which were consumed in the period but were not recorded yet, so they should be added to the expenses of the period. To summarize, adjusting entries are needed to capture all revenues and expenses included in this period to calculate the performance of each period accurately. So adjusting entries are related to expenses and revenues. Expenses that are not already recorded or used to generate revenue could be either paid in advance or accrued, which means not yet recorded. In both cases, you will need adjustments. Revenues also need adjustments at the end of the period, as they could be either collected in advance and should not be recognized, or revenue is realized but not recognized or recorded, or revenue is earned but not recorded. Both cases would need adjustments as well.